All right, thank you so much. We're going to dive right back into this because there's so much we still have to cover. We've kind of touched on a lot of the basics, what the form looks like, and then the fact that the standard deduction is dramatically different really perfectly dovetails right into this next part of it, which is we need to talk about those itemized deductions because the expectation is that many of our taxpayers are not going to be itemized anymore or not going to itemize on their deductions anymore. So what are those changes? First of all, our overall limit has been suspended. It used to be called the P's limitation, where we had deductions being phased out depending on the income of the taxpayer. So this really is a great move for our higher income taxpayers because their itemized deductions are no longer going to be phased out. So that is a dramatic change from, it sounds good, right, with no more phase out, but we have to weigh that against, what else is changing. The 2% miscellaneous itemized deductions, that is suspended. So if you look at everything that kind of falls within that category, the biggest item in here, unreimbursed employee expenses, that Form 2106, it really, for our average taxpayers, that doesn't exist anymore. It's been suspended. We can't use it anymore. There are a few little tiny subtle exceptions we're talking about, very, very, very tiny. I'll go ahead and if you look at my site, I'll have it in the manual. But for most of our rank and file taxpayers, it is suspended. They don't get to use it. Tax prep fees is one of them. Job training expenses, investment expenses, costs to determine or contest or pay or claim a refund of tax. All these different ones are part of our 2% miscellaneous itemized deductions. What about this one? Hobby expenses. Well, you still have to count the hobby income, but you no longer can take the hobby expenses against it because it falls in that 2% miscellaneous itemized deductions category. So that is a definite change for some taxpayers. For our ones that rely heavily on the unreimbursed employee expenses, that's going to affect their return pretty dramatically. Looking through some specific itemized deductions, looking at medical expenses, our threshold has decreased, and that's just temporarily here, from 10% down to 7.5%. So that's of the 7.5% of your AGI that you can take the deductions for anything over that. So that only applies during 2017 and 2018, but that's still going to be effective for our 2018 year that we're dealing with now. It is going to be applicable for both regular tax and EMT purposes. So that's one of the changes for our medical deduction. And I just threw in here because we very rarely see our mileage rate for medical change, but that actually went up from 17 cents to 18 cents per mile. So that is a change. And if you deal in anything with long-term care insurance, I went ahead and threw the chart in here for what it is for 2018 for the long-term care insurance premiums that are deductible. So if you have that applies, know that we basically have so many changes across the board that if you're using software, that's going to help you with a lot of the calculations, but it's still up to us to understand what those changes are and apply the logic test. As far as a little note about long-term care insurance, the per diem dollar threshold when you're computing the limits for how to exclude the benefits for long-term care insurance, that for 2018 is $360 for the per diem dollar threshold. So a couple little changes in there as we look at long-term care insurance premiums. And I just kind of threw it under this category just so that my goal too is to have the slides and all this information, something that you can refer back to quickly and get some information if you need to look it up. A pretty substantial change is dealing with mortgage interest. Our mortgage interest, basically the home equity portion of the deduction is suspended. So when somebody refinances and they include all this extra cost that has nothing to do with acquiring the home, well, that's not really going to be allowed anymore. What we look at is something called acquisition indebtedness. And you may see that in materials referred to as AI. If it was incurred before December 15th of 17, and then I put a little note in here, what do they mean exactly? They have to be entered into contract by that date and closed before January 1st and fully purchased by April. But basically, if that home was acquired after these dates, the maximum acquisition indebtedness, the maximum they can get there, the $1 million or $500,000 if it's married filing separate. If they refinance after that date, it doesn't change the $1 million. So this is kind of the before. All this occurred before. If it occurred after, so technically anything after December 16th, so it's incurring kind of after those dates and before this goes away in 2025, the maximum acquisition indebtedness changes. We don't get the 1 million amount anymore. So these homes that are more than 750,000, it's going to change how much mortgage interest is deductible. So the maximum acquisition indebtedness goes down to 750,000 instead, or 375,000 for married filing separate. So what happens after 2025? Basically, it all resets. It goes back to 1 million if they acquire it after 2025, and 500,000 for married filing separate. And honestly, it doesn't matter anymore when that debt was incurred. Did it happen before? Did it happen after? Because the law is set up this way that it's no longer suspended. It goes back to the way it was after 2025. All that doesn't matter. But we do have to watch when did they acquire the property. And if it's after those dates, then it does make a difference. So we have to watch that being the case. There's also a difference in state and local taxes. Well, state and local taxes was pretty generous in the past, especially if it was a state with really high property taxes. So property taxes, sales taxes, all this is within that realm. Now, I wanted to have a little side note as we're talking about this on the individual side. If you have property taxes or sales taxes for the purposes of carrying on a business, it doesn't affect it. Those are still deductible. So property taxes, so carrying on a business, let's say you have a rental and you have property taxes on it, that's still okay. A property tax or sales tax for a business in another capacity. It's not affecting that, but what we're looking at is the personal use side. So your personal deductions for any of these state and local taxes. Those are going to be limited. They cap $10,000 for all taxpayers. So that's kind of a kicker there, is if you're single, you get $10,000, married filing joint, you get $10,000. So you don't really get to double that deduction filing jointly. Unless you're married filing separate, then they will cut it in half and say, okay, your limit is $5,000. Which, just as a little side note, for somebody that says they're married filing separate, that and depending how they're they're itemizing deductions, that's on the face of that 1040 in our demographic section, one of those check boxes. So just watch for that. It's kind of changing that a little bit. So property taxes plus income taxes or sales taxes, if there's a state that you don't have income taxes, total of everything altogether, $10,000 cap, and that's effective from 2018 to 2025. Now, there was a lot of states that hurried in recently to try to say, oh, well, you can advance pay it, and the IRS came out with some anti-avoidance rules, basically, because some states had created these creative plans to say, oh, well, if you want to go ahead and we'll call this a charitable contribution because we've set up this fund and it'll go towards paying your property taxes. IRS says, no, wait a second. In September, they proposed regulations that says, no, we're not going to, you're not going to be able to do this. We're not going to allow this just because your state is being super creative. This is not going to change the fact that you're only going to get that $10,000 limit. So even if we look at, we said, okay, where can we start bunching that strategy? And I said it's mostly going to occur probably, maybe somebody has high medical, maybe some there, but probably in our charitable contributions because our state and local is capped. As we're looking at charitable contributions, having mentioned it, well, those have changed a little bit, and that's actually gone the other direction because we used to have it limited to 50% of your adjusted gross income was all that you could basically deduct in that year. They've increased it small amount. 60% is what that is now for any cash contributions from 2018 to 2025. Instead of a 50% limitation, it's now 60%. There is a couple little notes in here too, though. Inconsequential benefit received by donors also increased. So that means if the value of the benefits received by the donor is not more than $108 of value, or if they make a very small contribution, it's at least $54 and they only get some little token benefits like bookmark, calendar, mug, poster, little things like that. And those generally cost less than $10.80, then it's basically that those levels have increased. They used to have a much lower threshold before they considered a benefit to be received. So that's a nice change as far as how the charitable contributions work as well. For charitable contributions, as we look at it on a different realm, the higher institutions used to, in like exchange for a charitable contribution, they used to give like seating or even the right to buy tickets to an athletic event. That's no longer allowed for higher institutions. So that may dramatically change kind of how they're going about things. But those charitable contributions that they receive in donors, they can't exchange for some sort of athletic event or rights to buy tickets or anything of that nature. And the IRS did go ahead and issue some final charitable contribution substantiation reporting regulations as well. And within that, they held that long-term lease of a building couldn't contribute to a facade conservation easement. They've done some real careful digging into, and a lot of these come out of like court cases, and that kind of sets a precedent for that as well. However, on another side of charitable contributions, because of the California wildfire disaster, those relief efforts, if they're basically somebody is donating for the specific California wildfire disaster relief, the charitable deduction limitations are suspended. So individuals get to donate more and not worry about that 60% limitation of their adjusted gross income. Also, corporations that they also have some special carryover rules, but those limitations are suspended to allow for more donations to go towards those disaster relief efforts. So that is a nice change as well to allow for the recovery in those disaster relief areas. So a lot of our itemized deductions, we have to change our planning dramatically because our old held, tried and true systems and methodologies are no longer going to operate the same way. So it's just knowing that there's some of these rule changes, and then we have to help our clients to understand them as well, of course.